Okay, let's unpack this. You might be feeling it right now, that heavy weight of debt. Maybe it's the stack of bills on the counter, right?
Mm-hmm.
The relentless monthly payments, the way interest seems to pile up faster than you can pay it down, or just that little knot of anxiety you feel every time your phone rings, wondering if it's another creditor.
Yeah, it's a tough spot to be in. And you are definitely not alone. The sources we're looking at today, they tell us that consumers across North America are wrestling with something like, over $16 trillion in debt?
16 trillion, that's just staggering.
It is. And that number just keeps climbing. It's a massive, massive sum, a truly daunting mountain if you're, standing at the bottom looking up.
And when you're in that situation, feeling underwater, the advertisements you see from debt settlement companies can sound like a lifeline, don't they?
They really do. They make big, appealing promises.
Oh.
A quick fix, slash your debt by a huge percentage, potentially saving you thousands of dollars.
It's an incredibly tempting message when you're feeling desperate for relief.
Absolutely.
But here's the critical question, right? The one driving this deep dive based on all these sources you've shared with us today. When you're facing that debt mountain and these companies offer that seemingly perfect solution, do they really help you in the long run?
Or could signing up actually leave you worse off? Potentially, wrecking your credit score and your overall financial future.
Exactly. That's our mission today, to cut through the noise, look at the claims and the reality based only on the information in these documents you gave us, and really understand the true landscape of debt settlement.
Yeah, and what's really interesting when you lay out all this material is just the range of perspectives we have here.
Right.
We've got official reports from credit bureaus like Experian. We have insights from consumer protection groups like the Better Business Bureau, practical details from financial education sites like InCharge and Investopedia, and even firsthand experiences people shared online, like in that Reddit thread. Plus, warnings and claims from a company actually in the industry, New Era Debt Solutions.
It's quite a mix. So our goal is to use all this information, these, diverse sources, to build a complete picture. We need to understand precisely what debt settlement is, according to these documents anyway.
Right.
Dig deep into the significant risks and downsides they highlight because, spoiler alert, there seem to be quite a few.
Oh, definitely.
But also look honestly at any potential benefits they mention. And crucially, explore the safer alternatives that these sources recommend.
And just to be clear, this isn't about us telling you what you should do.
No, not at all.
It's about equipping you with the detailed, source-verified knowledge. We're here to guide you through the specifics, what debt settlement involves, the actual mechanics, the timelines, the documented impact.
So you can clearly see the potential landscape, understand the pitfalls, and then make an informed decision about what path, if any, feels right for your specific situation.
Exactly.
All right, let's jump in then. Let's start with the basics, just as defined by the sources. What exactly is debt settlement? What's the core idea these companies are built on?
Okay, so based on the definitions we see in sources like InCharge, Wikipedia, the BBD study, debt settlement, sometimes they call it debt reduction or negotiation or resolution. It's a process where you basically hire a third-party company to negotiate with your creditors for you. The main goal is to convince those creditors to accept a lower amount than the total balance you actually owe.
So you're hiring someone to haggle for you, essentially. And these companies, they're typically businesses trying to make a profit, right?
That's a really key point.
Yeah.
Experian and InCharge confirm they're usually for-profit businesses, and they mainly focus on unsecured debts.
Okay, unsecured debt. Let's just clarify that for you listening.
Right.
That means debt where there isn't an asset, like a house or a car, physically tied to the loan that the lender can just take if you don't pay.
Right.
We're talking things like credit card balances, personal loans, medical bills, maybe lines of credit.
Precisely. And sources like InCharge and Wikipedia are very clear. Secured debts, like your mortgage or your car loan, generally cannot be settled through this process. Now, the claim these companies make, the really enticing part, as the BBB outlines it, is that they can help you significantly reduce your overall debt load. They often aim to settle for less than the full amount.
Okay.
And then they structure either a lump sum payment or maybe a payment schedule for that reduced figure. Wikipedia mentions they often aim for settlements around, say, half of what you owe, though they do caution results can vary a lot.
Reducing debt by half. I mean, that does sound incredibly attractive if you're feeling overwhelmed. But how do they get the leverage? How do they convince a creditor to take less than they're actually owed? What's the critical step in their process?
Okay, this is where the process starts to get quite risky. And it's something that's consistently highlighted as a major concern across multiple sources we looked at.
Mm-hmm.
The core mechanism, the thing debt settlement companies often advise, or sometimes even require their clients to do,
Mm-hmm.
is to stop making payments to their creditors.
Stop paying?
Yes. Experian, the BBB, InCharge, Wikipedia, they all describe this as pretty central to the whole strategy.
Wait, stop paying your bills. That seems completely counterintuitive. If you're trying to fix a debt problem, why on earth would you deliberately stop paying?
Well, the stated reason, according to sources like Experian, is sort of twofold. First, by stopping payments and going into default, you're signaling to the creditor that you're facing real financial hardship.
Okay.
The idea is this creates leverage for negotiation. The creditor might become more willing to accept a lower settlement amount rather than risk getting nothing at all if you were to, say, file for bankruptcy down the line.
I see. And the second reason?
The second part is that stopping payments allows you to start accumulating funds, money that can then be used to offer a lump sum settlement to the creditor once, or if a deal's actually reached.
And where does that money go while this is happening? The money you're saving by not paying bills, do you just keep it in your checking account?
No, absolutely not. That would be a huge red flag.
Mm.
Sources like Experian and the BBB state you deposit that money into a separate savings or escrow account, which is managed or overseen by the settlement company. And the New Era 14 question source, plus a BBB tip to give a really vital detail here. Legitimate companies must require you to hold these funds in a third-party FDIC-insured trust account.
Ah, third party, so not the company itself.
Exactly. New Era explicitly warns if a company tells you to just save the money yourself or send funds directly to them, you should be very, very cautious. The funds really need to be held by an independent entity for your protection.
Okay, so the process is deliberately start paying creditors, funnel that money into a protected third-party account, and then wait while the settlement company tries to negotiate using that pot of money. How long does this holding and negotiation phase actually take? Is it, a fast track out of debt?
No, the sources are very clear on this point.
Yeah.
Debt settlement is absolutely not a quick fix.
Yeah.
Experience risks, source states flat out the entire process, can often take up to 3, maybe even 4 years to complete.
3 or 4 years.
Yes. And the BBB study reinforces this, noting it can take years before any of your debts actually get settled. Now, the New Era source, the company one, estimates a first settlement might happen within 6 months, sometimes maybe 90 days.
Right.
But they also explicitly say there are just too many variables involved to give you exact times or costs for the whole process.
Wow. 3 or 4 years of deliberately not paying your creditors while you wait for settlements? I mean, that time frame alone sounds like it would have some pretty serious consequences.
It does.
And that brings us right to the substantial risks and downsides of debt settlement, which, as you said, are heavily documented across these sources.
Yes, this is really where that appealing promise starts to bump up against the harsher realities that are outlined in the documents. The impact on your financial health, and especially your credit score, can be particularly severe.
And the number one risk, the one that seems most consistently emphasized, is the severe damage this process does to your credit score.
This is really the core mechanism working against you here. As Experian's risk source points out, that requirement to stop making payments, it's fundamentally at odds with how credit scores are calculated. Payment history is the single most significant factor in your FICO score.
How significant?
It counts for a massive 35%.
35%, just from paying on time.
Just from payment history, yes.
Mm-hmm.
Think about that. More than a third of your credit score, according to Experian, is just based on whether you pay your bills on time. It's the single biggest piece of the pie.
So when a debt settlement company tells you to stop paying, you're not just missing a payment. You are directly hitting the absolute most important part of your credit health head on.
Exactly. Every single missed or late payment gets reported to the major credit bureaus, Experian, Equifax, TransUnion.
Right.
Experian Risks confirms this will significantly damage your scores. And Investopedia adds an important nuance. Your score takes a hit, even though the whole point is you're working towards reducing your overall debt. The act of defaulting itself is what causes the damage.
And it's not just the ongoing missed payments during that, multi-year negotiation period, is it? What happens to your credit report after a settlement is finally reached? Does it go back to normal?
Unfortunately, no. Even once a debt is settled for less than the full balance, the account gets reported on your credit history with a negative status marker, something like paid settled, or settled for less than full balance, things like that.
And that's bad.
Yes, both Experian Risks and Investopedia explain that this is considered a negative mark because the creditor agreed to take a loss on the debt you owed them. Experian Risks specifically notes your credit report will clearly show if you settled for less than the full amount.
And this damage isn't just a quick blip, right? It lingers.
It really does. Late payments and those negative settlement status marks can remain on your credit report for a substantial period, typically up to 7 years.
7 years.
7 years from the date of the original delinquency on that account. That's according to both Experian Risks and Investopedia.
7 years? That's a really significant chunk of your financial life where your credit history is reflecting those negative events. How much does the severity of the impact vary from person to person?
Well, Investopedia points out it can depend heavily on where you start. If you had a high credit score before entering settlement, you're likely to see a more dramatic drop than someone whose score was already pretty low.
Makes sense.
The overall effect is also influenced by your current credit condition, the total amount of debt being settled, and critically, whether you manage to keep payments current on any other debts you might have that are not included in the settlement plan.
Oh, okay.
And settling multiple accounts is going to hurt your score more than just settling one.
So let's just make this real for you listening. Why does having a severely damaged credit score for up to 7 years actually matter? It's not just a number, right?
Oh, absolutely not. It has significant real-world consequences that can impact your life for years to come. A low credit score makes it considerably harder to get approved for new credit cards, personal loans, even bigger things like car loans or mortgages down the road.
Right.
And if you do get approved for something, you'll almost certainly face much higher interest rates. That could cost you potentially thousands or even tens of thousands of dollars more over the life of the loan compared to someone with good credit.
Wow.
And the sources imply, though don't always spell it out, that it can impact your ability to rent an apartment, get certain types of insurance, and sometimes even affect job opportunities if an employer checks credit reports. It just puts up substantial hurdles when you're trying to rebuild financial stability.
Okay. So beyond just the general credit score damage from missed payments and the settlement mark, that prolonged period of not paying could lead to something even worse for a specific account. A charge-off. What's that?
Yes. That's another significant risk. A charge-off happens when a creditor basically gives up on collecting a debt, determines it's unlikely to be paid, and writes it off as a loss for their own accounting purposes. They essentially close the account.
And that happens because you've stopped paying for so long.
Exactly. Experian Risks states this becomes more likely the longer payments are withheld, especially over that 3 to 4 year time frame we talked about for the settlement process.
And like late payments, a charge-off, that stays on your record for a long time too.
Correct. A charge-off typically remains on your credit report for 7 years from the date of the initial delinquency. That's the first missed payment that started the whole thing, according to Experian Risks. So you risk adding the severe negative mark on top of the ongoing damage from all the missed payments.
Okay, so you're facing severe, long-lasting credit damage, potentially charge-offs. On top of all that, this whole process isn't free, right? There are costs involved with hiring these companies.
Absolutely. Remember, debt settlement companies are usually for-profit businesses, and they charge fees for their services, as stated clearly in Experian's for alternative source.
How are those fees usually calculated?
Typically, they charge a fee calculated as a percentage of the settlement amount they negotiate for you.
Okay. The amount saved or the final settlement amount?
The final settlement amount. So Experian sources put this range typically between 15% and 25% of the amount you actually agree to pay the creditor.
So just to walk through that, if a company negotiates a $10,000 debt down to a $5,000 settlement,
Right.
their fee would be somewhere between $750, which is 15% of the $5,000, and $1,250, 25% of the $5,000. And that's in addition to the $5,000 you have to pay the creditor.
Exactly. Now, Wikipedia does note that some sources mention fee ranges going much higher, maybe even up to 75% of the total original debt to be settled. But the more commonly cited range seems to be that 15–25% of the settled amount.
Are there other fees people should be aware of beyond that main negotiation percentage?
Yes, potentially. Experian Risks mentions that companies might charge fees for administering that dedicated savings or escrow account where your funds are held during the process.
Okay.
And Wikipedia adds that the bank agent, the third party holding the trust account, might also charge its own separate monthly maintenance fee. So these costs can definitely add up on top of the money you're trying to put aside for the actual settlements.
This is where that real-world story from Brittany in the BBB study is just incredibly eye-opening, isn't it?
It really is.
She had over $36,000 in debt, signed up for a settlement plan. Over 5 years, she paid about $27,000 into the program, thinking, that money was going towards paying down her debt.
Right. That's the assumption.
But when she looked closer, only about $5,800 of that $27,000 had actually been paid to her creditors.
Wow.
The vast majority, over $21,000, had gone straight to the debt settlement company in fees.
Brittany's story is such a powerful and frankly concerning illustration of how significantly fees can just eat up the money you're paying into these programs. For years, a huge portion of her payments went to the company, doing very little to actually reduce the principal she owed.
It's frightening. And speaking of fees, there's a critical legal protection consumers absolutely must know about regarding when these fees can be charged. This is highlighted across multiple sources, right?
Yes, this is non-negotiable.
Yeah.
It's a major way to spot potentially illegal operations right off the bat. The Federal Trade Commission, the FTC, has its specific rule. It's cited by Experian Risks, the BBB tip, Wikipedia, and heavily emphasized in that new Era 14 questions source.
And the rule says
Legitimate debt relief companies cannot charge large upfront fees for their services before they actually achieve a result for you.
okay, so if a company asks for several hundred or even several $1,000s just to enroll you or to get started before they've settled anything, that's a huge red flag. It's likely illegal.
It's not just likely. According to these sources, it is illegal under that FTC rule. Fees can only be collected after a settlement has been successfully negotiated with a creditor, after you, the client, have approved that specific settlement, and after you have made at least one payment towards that settled amount.
Okay, that's very clear.
And the new Era 14 questions source specifically warns you, be wary of companies claiming some kind of legal model or an attorney relationship makes them exempt from this rule. New Era states clearly there is no such exemption under the FTC's telemarketing sales rule.
Good to know.
They also warn about companies trying to sell you some separate upfront product, like maybe educational materials, just as a way to collect money before doing any actual settlement work.
And the BBB study gives a very real, high-profile example of this exact violation being enforced, right? With Lexington Law.
Yes, exactly. The Consumer Financial Protection Bureau, the CFPB, took action against Lexington Law and its parent company Progrection, alleging they charged illegal upfront fees for credit repair services, which falls under similar rules.
And the fine they're seeking is huge.
Massive. The CFPB is seeking $3.1 billion in that case, specifically to repay consumers for those alleged illegal fees, citing violations of the telemarketing sales rule.
Wow. That case really underscores that this isn't just some minor technicality. It's a serious consumer protection that regulators do enforce, and violations can have huge consequences for the companies involved.
And hopefully restitution for the consumers affected. It's maybe the single most important consumer protection detail to take away from these sources regarding fees.
Okay, so we've got the credit damage, potential charge-offs, fees that can consume your payments, and the critical warning about illegal upfront fees. What about the money that is actually forgiven in a settlement? Does that just vanish, or are there financial strings attached there too?
Yes. There are potentially significant strings attached, and they come in the form of tax implications. Yes. Experian Risks, InCharge, Wikipedia, the New Era source, they all clearly state that when a creditor agrees to settle your debt for less than the full amount owed, the difference, the amount of debt that was forgiven, might be considered taxable income by the IRS.
Wait, so the money I didn't have to pay back could be treated as if I earned it. That's surprising.
It can be a big surprise for many people, yeah. And it's a crucial point that often gets overlooked. Experian Risks confirms you may owe taxes on that forgiven difference.
How does that work practically?
Both Experian Risks and Wikipedia mention that if a creditor forgives $600 or more of debt in a year, they are generally required to send both you and the IRS a Form 1099-C, which is specifically for reporting canceled debt.
So a settlement could potentially solve one problem, the debt, but actually create a new problem with the IRS. Is there any way around owing taxes on forgiven debt?
Well, Wikipedia, referencing IRS Publication 525, does mention an important exception. It's called the insolvency exclusion.
Insolvency exclusion, okay.
If you were legally insolvent at the exact time the debt was forgiven, meaning your total liabilities, your debts, were greater than the fair market value of your total assets, you might be able to exclude some, or possibly all, of that canceled debt from your taxable income.
How much can you exclude?
It depends on the degree of your insolvency. Wikipedia gives an example. Let's say you had $10,000 in total debt, but only $3,000 in total assets, right when a portion of that debt was forgiven. You were insolvent by $7,000, $10K liabilities, $3K assets.
Okay.
In that scenario, you might be able to exclude up to $7,000 of the forgiven debt from your income. Any amount forgiven above that $7,000 level of insolvency could still potentially be taxable.
That sounds kind of complicated to figure out accurately.
It definitely can be. Both Investopedia and the New Era 14 question source strongly recommend consulting with a qualified tax professional or a financial advisor.
Right.
They can help you understand the potential tax consequences based on your specific financial situation at the time of the settlement. You really shouldn't just assume that forgiven debt is tax-free.
Okay, good advice. So beyond the inherent risks of the settlement process itself, credit damage, fees, taxes, there's also the risk of just dealing with a shady company or falling victim to an outright scam. The sources touch on this too, right?
Unfortunately, yes. People who are already struggling with debt and actively looking for help are, sadly, particularly vulnerable targets for scamming.
That makes sense.
The BBB highlights some alarming data. Over half of consumers who reported scams in 2023 actually experienced a monetary loss. And debt relief scams are, unfortunately, pretty common within that landscape.
So what are the key warning signs? The red flags you should look out for, according to these sources, when you're approached by or considering a debt settlement company?
Okay, we've already hit the biggest one, which is also illegal. Asking for large upfront fees before providing any service or reaching any settlement. Experian risks, the BBB tip, New Era, they are unanimous on this. Huge red flag.
Got it. No upfront fees. What else?
Other red flags mentioned include getting unsolicited contact via annoying robocalls or those ringless voicemails. The BBB mentions a company called Stratix Networks used for this. Any company promising they can magically remove legitimate, negative, but accurate information from your credit report, the BBB points out accurate marks stay for 7 years, period.
Right, they can't change facts.
Exactly. Also, companies claim to be affiliated with or endorsed by a government agency, like that story of Tammy in the BBB study, who got caught in a deceptive student loan scam, refusing to clearly tell you your rights as a consumer, using high-pressure tactics to rush you into signing a contract, or asking for your personal banking information before you're absolutely sure they're legitimate and you actually want to proceed.
The New Era 14 question source adds another good one too, didn't it? About outsourcing.
Yes, that's a really interesting point they make. Watch out if the company you're talking to plans to outsource the actual negotiation work to a different provider entirely.
But why is that a problem?
They warn that the company you sign up with, the one making the promises, might not be the one actually handling your case day to day. That can lead to confusion, lack of accountability, and maybe finger-pointing if things go wrong.
That lack of transparency seems like a bad sign, and the BBB study provides some really concrete examples of these scams hurting real people, doesn't it?
It does. It puts faces to the risks. Crystal paid over $1,500 to Lexington Law, felt her situation got worse, even had issues with her personal info being mishandled. Mohammed paid $500 to 123 Credit Restoration, promising to remove negative marks. Nothing happened. And then there are more severe cases. Michael and Valerie Rando's credit repair company was called bogus by the FTC, charged thousands for fake services, even gave illegal advice related to COVID benefits. ACRO Services was banned by the FTC from telemarketing and selling debt relief after scamming older Americans with false promises. And two other companies, SL Finance and BCO Consulting, were temporarily halted by the FTC for running deceptive student loan schemes where they falsely claimed government ties.
These anecdotes from the BBB study really hammer home that these risks aren't just theoretical possibilities. People are actually losing serious money and making their financial situations worse by falling for these kinds of schemes.
It just makes the importance of spotting those red flags, doing your research, and being skeptical absolutely critical.
Okay. So beyond the risk of scams, let's say you find what seems like a legitimate, compliant debt settlement company. Is there any guarantee that the process will actually succeed in settling your debt?
The sources are quite blunt about this. There's absolutely no guarantee of success.
Really?
Yes. Experian Risks explicitly describes debt settlement as a gamble. There's a very real possibility that you could follow the whole process, stop making payments, diligently save money in that escrow account for months, maybe years, endure all the credit damage, only for the negotiation attempts to ultimately fail.
Why wouldn't a creditor agree to negotiate? Don't they want some money back?
They often do. But InCharge points out creditors are under absolutely no obligation to agree to settle for less than the full amount you owe them. And the BBB, InCharge, and Wikipedia all state that simply not all creditors will negotiate. Some just have policies against it.
Oh.
Wikipedia specifically mentions that Discover Card, for example, is known in the industry for being particularly resistant to settlement negotiations, sometimes aggressively so.
Interesting.
And even if a creditor is willing to negotiate, the amount they offer might still be more than you can realistically afford to pay, as InCharge notes.
So you could potentially go through years of damaging your credit, saving money, only to have the negotiations fall through, leaving you right back where you started with the full debt, maybe even more with fees and interest, or possibly worse off because your credit is now shot.
That is precisely the risk, as outlined by Experian Risks. They state you could absolutely end up worse off if negotiations don't work out after you've already damaged your credit by stopping payments.
Is there any data on how often this happens, like success rates?
The BBB study presents some concerning data points. It mentions that nearly half of people who entered a debt settlement plan actually dropped out before completing it.
Half. Wow.
Yeah. Now, some of those dropouts might have settled some debt, but it shows it's hard to stick with. The study also cites other data suggesting low completion rates for settling all enrolled debts. One survey found only about a third, 34.4%, had settled 75% or more of their debt within 3 years. And data cited from the Colorado Attorney General showed only 11.35% had settled all their enrolled debt after 3 or more years.
So settling everything seems relatively uncommon based on that data.
It appears challenging, yes.
That Reddit thread we keep mentioning adds a really fascinating insider perspective on this whole gamble idea, doesn't it? From the bank collections worker.
Yes. That comment was gold. This person, working in collections at a bank, confirmed that debt settlement companies are real, they do exist, and they do negotiate settlements. They even mentioned their bank would sometimes go as low as a 47% discount.
Okay, so they can work.
They can. But this insider also described the companies they dealt with as often being really unorganized, sometimes taking maybe 2 years just to start the negotiation process on an account. Or occasionally doing seemingly nothing at all, leaving the client frustrated and calling the bank directly anyway. Their overall conclusion from the creditor side was, and I'm quoting loosely here, "It is a gamble working with debt settlement companies, but it's a gamble I would not take and I would not recommend taking."
Wow. Coming from someone inside the bank, that really underscores the unpredictability, the potential inefficiency, and reinforces that idea that it's just not a guaranteed path to resolution at all.
Exactly.
Okay, so what happens in that worst case scenario? If negotiations fail or a particular creditor just refuses to work with the settlement company while your account is sitting there delinquent, what's the ultimate risk mentioned in these sources? Could it get worse than just owing the money?
Yes, it potentially could. Sources like InCharge and Wikipedia clearly mention the possibility of being sued by your creditors. Yes, creditors, or the debt buyers they might sell your delinquent debt to, reserve the right to file a lawsuit against you while your accounts are in default during the settlement process. That's according to Wikipedia. The BBB adds that if negotiations fail, or a creditor simply refuses to cooperate, they could ramp up collection activity. And that could very well lead to taking you to court.
And if a creditor sues you and wins, what happens then?
The consequences can be pretty severe. The BBB states that in some cases, consumers could face wage garnishment.
Where they take money directly from your paycheck.
Exactly. A court orders your employer to withhold a portion of your wages and send it to the creditor until the debt is paid. Or they might be able to place liens on your assets, like your home. InCharge refers to this potential outcome, lawsuits, garnishments, liens, as the worst-case scenario for many individuals going through this.
No, it's interesting. Some sources seem to present a slightly different view on how likely you are to actually get sued during settlement, right?
Yes, there's a bit of divergence there. Wikipedia mentions claims by some sources, and often the settlement companies themselves, that the actual risk of a lawsuit is relatively low, especially if you are consistently making your payments into that escrow account.
Okay.
The New Era 14 Questions source, for instance, claims that they continue trying to negotiate, even if client gets sued, and they state that their client's chances of being sued are quite low. Wikipedia even notes some companies offer legal expense insurance as part of their program.
So maybe the risk isn't that high.
Well, however, and this is crucial, You have sources like the BBB and InCharge that explicitly list the potential for lawsuits, wage garnishment, and liens as clear, documented risks of entering debt settlement in the first place. So we're presenting all the perspectives we found in the sources you shared,
Right.
but the possibility of legal action is definitely a documented concern from multiple credible angles, and it represents a really significant potential downside if it does happen to you.
And if a creditor does get a judgment against you after a lawsuit, Wikipedia points out your options at that point might be pretty limited. Either pay the full amount owed plus all the accumulated interest and court costs, or potentially file for bankruptcy.
Which, as you pointed out earlier, might be the very outcome someone was trying to avoid in the first place by going down the debt settlement path.
Exactly. Okay, so we've really dug deep into debt settlement itself, the initial promise, the actual process involving stopping payments, the surprisingly long timeline, and that whole daunting list of significant risks. The severe, long-lasting credit damage, potential charge-offs, fees that can eat up your payments, the risk of a surprise tax bill, the unfortunate prevalence of scams, the fact there's no guarantee of success, and that potential threat of lawsuits and wage garnishment. Phew. Given all those downsides documented in the sources, are there other paths, safer ways out of debt that these documents suggest?
Oh, absolutely. Multiple sources, especially Experian's 4 Alternatives and 6 Risks articles, but also InCharge, the BBB study, and Wikipedia, they all detail several alternative strategies for dealing with overwhelming debt. And these are generally considered much safer and less damaging, particularly to your credit, than debt settlement.
Okay, good. Let's start with one that often gets confused with settlement, but you're saying is fundamentally different: credit counseling and debt management plans, or DMPs.
Yes, this is very widely recommended, often as the responsible first step to take when you find yourself struggling with debt. The sources describe these services as typically being offered by nonprofit agencies.
Nonprofit, okay.
Yes, and Experian and the BBB strongly advise looking specifically for certified nonprofit credit counselors. Maybe ones accredited by reputable organizations like the NFCC, the National Foundation for Credit Counseling.
And what does a credit counselor actually do?
Well, a good counselor will start by reviewing your entire financial situation: income, expenses, debts. They help you understand where your money is going, work with you to develop a realistic budget, and often that initial counseling session is free.
Okay.
Now, if your debt situation is pretty severe, they might recommend enrolling you in a debt management plan, a DMP.
Right. And how does that work?
Experian and the BBB explain that under a DMP, the counselor negotiates with your creditors. But here's the key difference. They negotiate not to reduce the principal amount you owe, but for more favorable terms. Things like significantly reduced interest rates, maybe getting late fees waived. They structure a single, affordable monthly payment plan based on your budget.
And you pay the agency.
Yes. You then make one monthly payment directly to the credit counseling agency, and they handle distributing the funds to your various creditors according to the agreed-upon plan. That's described by Experian and the BBB.
Okay, so this is the really critical difference from settlement.
Sure.
You are still making payments every month.
Exactly. With a DMP, you continue making consistent monthly payments, just consolidated through the agency. You are not stopping payments and deliberately defaulting on your debts. Experian's 4 Alternative source explicitly contrasts this, stating that with a DMP, you do not stop paying, unlike with settlement.
How does a DMP affect your credit score then, compared to settlement?
Well, your accounts that are included in the DMP might be closed by the creditors involved. That can still affect your credit utilization ratio and potentially have a moderate negative impact on your score, according to Experian.
Okay, so not totally harmless.
Not totally harmless, but here's the crucial part. Because you are agreeing to pay the debt back in full over a structured period, typically 3 to 5 years, according to Experian and InCharge, the impact on your credit score is described by Experian's 4 Alternative source as being far less damaging than the severe, long-lasting damage caused by stopping payments entirely with debt settlement.
Far less damaging. That's a key phrase. And what about the costs for credit counseling in these DMPs? Are they expensive like settlement fees?
Generally, much, much lower. Experian's Risks article mentions typical fees for DMPs might involve a small initial setup fee, maybe in the $30 to $50 range,
Okay.
and then an ongoing monthly maintenance charge, usually somewhere between $20 and $75. And the BBB notes that accredited nonprofits often provide that initial counseling for free, and they may offer reduced or even waived fees for the DMP itself if you genuinely can't afford the standard charges.
That seems much more reasonable.
It really does. And that quote from the NFCC CEO in the BBB study is pretty memorable, right? They compared jumping straight to debt settlement to considering amputation for just a scratch,
Yeah.
suggesting that credit counseling and DMPs are really the widely recommended first line of defense.
Okay. So a DMP, paying off the debt in full, but hopefully faster and cheaper due to lower interest structured payments and much better for your credit than settlement. What about tackling high interest debt directly with, say, a new loan?
Right, that's the strategy behind a debt consolidation loan. It's another alternative mentioned by Experian, the BBB, and InCharge.
How does that work?
It basically involves taking out a single new loan, ideally, one with a lower interest rate than the sort of weighted average of all your existing high-interest debts, and then using the money from that new loan to immediately pay off multiple other outstanding debts, like maybe several credit cards or personal loans.
And then you just have the one payment on the new loan.
Exactly. Once those existing debts are gone, you just focus on making that one single monthly payment on the new consolidation loan.
What's the main advantage of doing it this way?
The primary benefit, highlighted by Experian, the BBB, and InCharge, is the potential to significantly reduce your overall interest costs if you can qualify for a lower rate. That can save you a substantial amount of money over the life of the loan.
Makes sense.
And it also simplifies your financial life, right?
Hmm.
Rolling multiple payments into just one monthly bill, that can really help with budgeting and managing cash flow, as noted by Experian Risks.
Is this option available to everyone, though? What if your credit isn't great because you're already struggling?
That's the catch. Experian and the BBB point out that securing a debt consolidation loan with a really favorable interest rate typically requires good credit.
Right.
Your options might be more limited, or the interest rates offered might not be much better than what you already have if your credit score is already low. But Experian notes it could still be possible, maybe through a credit union or a secured loan. They also suggest that the sooner you explore this option when you start dealing with debt, the better your chances are of qualifying for good terms before your credit takes a bigger hit.
Good point. And the BBB adds a little caution, too, right? About not racking up new debt.
Yes, be disciplined. Avoid running up balances on the credit cards you just paid off with the consolidation loan. Otherwise, you could end up with a consolidation loan plus new debt, putting you in an even worse position.
Okay. What if the debt is primarily just on credit cards, and maybe your credit is still reasonably decent? Is there a specific credit card strategy mentioned in the sources?
Yes, absolutely. Using a balance transfer credit card is another alternative discussed by Experian and the BBB. This involves transferring your existing high-interest credit card balances onto a new credit card that offers much better terms, at least for a while.
And the key attraction here is usually that 0% intro APR deal you see advertised.
Exactly. Balance transfer cards often feature an introductory 0% interest rate period. Experience for Alternative Source mentions these periods can sometimes last as long as 21 months.
Wow, nearly 2 years.
Yeah. It gives you a really significant window where you can make substantial payments towards knocking down your actual principal balance, and none of that payment is getting eaten up by interest charges. That leads to much faster debt payoff and potentially significant savings on interest.
Are there costs or requirements for doing a balance transfer?
Yes, there usually is a balance transfer fee. Experian sources put this typically in the range of about 3% to maybe 5% of the total amount you transfer over to the new card.
Okay, so there's an upfront cost.
There is. And similar to consolidation loans, you generally need a good or even excellent credit score to get approved for the best balance transfer cards, especially those with the really long 0% intro periods.
Right.
Experian for Alternative Source emphasizes this is a move best made while you are still making regular payments on your existing cards before you start falling behind and your credit score drops.
Okay. So we've got credit counseling and DMPs, debt consolidation loans, balance transfer cards. These all seem to involve continuing to make payments in some way and are designed to avoid that catastrophic credit damage we saw with stopping payments and settlement. But what about just doing the negotiation part yourself? Is that actually possible according to these sources? Can you just call up Discover or Chase and try to settle?
Yes. This is a really significant point raised by Experian's for Alternative Source, InCharge, and Wikipedia as well. InCharge actually states it's a commonly unknown fact that you can perform the same negotiation services that debt settlement companies offer, but do it yourselves and avoid paying their fees.
But don't the settlement companies claim they have, like, special relationships with creditors or secret strategies you wouldn't know about?
Yes, that's a very common marketing claim they make. But the InCharge source directly refutes this. They say settlement companies don't possess any magic tricks, loopholes, or other methods they can legally provide that you couldn't potentially access or do on your own behalf.
Interesting. So if you decide to try the do-it-yourself, the DIY route,
Right.
what steps should you take? How do you even start?
Well, Experian and InCharge suggest simply calling your creditors directly. Just pick up the phone.
Okay.
You can inquire about various options they might offer. Things like workout agreements, maybe they can offer a temporarily reduced interest rate or a lower minimum payment for a period, or perhaps temporary forbearance or a hardship agreement if you're facing a short-term financial crunch, like job loss or medical issue. Experian also confirms you can absolutely attempt to negotiate a settlement for less than the full amount owed yourself.
But why would a big bank or credit card company be willing to negotiate directly with just me, an individual consumer? Wouldn't they prefer dealing with a settlement company?
Not necessarily. InCharge quotes an expert, Hubert H. Rivera, stating that creditors understand many people have been through tough economic times, especially recently, and they are often quite willing to work directly with their customers, particularly if you are proactive and initiate the conversation. And Wikipedia adds a good point. Fundamentally, it's an economic transaction for the creditor. They are looking to recover as much money as possible on a debt that they might otherwise lose entirely if you ended up filing for bankruptcy.
Right.
They might actually recover more through a direct settlement with you than if they had to sell the debt off for pennies on the dollar to a third-party collection agency. Wikipedia notes those agencies might only pay 1 to 12 cents on the dollar for the debt, and then they might settle for even less than the original creditor would have accepted directly from you.
Ah, that makes economic sense for them too.
Exactly. And InCharge also mentions that avoiding the potential costs and the lengthy process of pursuing legal action against you is another incentive for creditors to try and settle directly if possible.
That Reddit thread we keep referencing had that truly compelling real-world example of this DIY approach working incredibly well, didn't it? The user, Western Bend 5309.
Yes, that story is a fantastic illustration of just how successful direct negotiation can be sometimes. This user had a significant amount of credit card debt, apparently considered debt settlement briefly, but was really worried about the severe credit damage and all the potential complications we've been discussing.
Understandable.
So instead, they decided to just call their primary creditor, which was Chase. Now, they were initially declined for a hardship program when they first called.
Oh.
But, and this is critical, they didn't give up. They called back, apparently following some advice from a helpful rep on how to better present their income and expenses. And on that second call, Chase offered them a 0% interest balance liquidation plan spread over 60 months.
0% for 5 years on a large credit card balance. That is incredible. That must have saved them thousands in interest.
Absolutely. It really highlights what can sometimes be possible just by asking and being persistent. They also mentioned they successfully negotiated a 6% interest rate for 12 months with American Express on another balance they had.
Wow.
And this user explicitly advised other people in similar situations to just call their credit card companies directly first and definitely avoid bankruptcy for that kind of debt level if possible. They did note, importantly, that often to be eligible for these types of internal hardship or liquidation programs offered directly by creditors, you usually need to be current on your payments when you make the call.
Ah, okay. So you need to act before you fall too far behind.
Right. But their experience is just a powerful testament to potentially saving thousands in interest, avoiding those hefty third-party fees, and crucially, avoiding the severe credit damage of settlement just by taking the initiative to negotiate themselves.
So the main advantage of DIY negotiation seems pretty clear. You save all those potentially significant fees that the settlement company would charge. That's pointed out by Experian and Wikipedia.
That's undoubtedly the biggest draw, yes. Saving potentially 15–25% or more of the settled amount is huge. However, the sources also detail several potential disadvantages and challenges to trying to do it all yourself. These come primarily from Wikipedia and InCharge and are sort of echoed in the New Era 14 Questions source too.
Okay, like what?
Well, for one, Wikipedia notes that dealing with your own debt directly can be really emotionally difficult. It can be hard to stay objective, advocate strongly for yourself, or remain disciplined throughout what might be a stressful negotiation process.
That makes sense. It's personal. And some sources suggested you might be more likely to face lawsuits if you try to negotiate on your own. Is that true?
Wikipedia does mention this as a potential disadvantage compared to using professionals. They suggest creditors might sue individuals more readily. However, it's important to note, Wikipedia itself adds that this claim is sometimes made without a clear source cited and could potentially be biased information spread by the settlement industry itself.
Ah, okay. So, grain of salt there.
A bit, yes. But they do reiterate that if a creditor does obtain a judgment against you while you're handling it yourself, your options might be narrowed down to paying the full amount plus interest or filing bankruptcy. Wikipedia lists this as a disadvantage compared to professionals who, they claim, might be able to continue negotiating even after a lawsuit is filed. Although, as we noted earlier, other sources cast doubt on how often or successfully that post-suit negotiation really happens.
Right. What other challenges are there to going it alone?
Wikipedia points out that some creditors might simply be less willing to settle directly with individual consumers compared to established settlement companies. Or maybe their internal processes for individuals are just more rigid or less favorable. You might face less advantageous settlement rates compared to companies that negotiate settlements in bulk or claim established relationships. It can also be really difficult and time-consuming just to reach the right person at the creditor's office, someone who actually has the authority to approve a settlement offer. That can lead to long delays and frustration.
Yeah, getting past the first line of customer service.
Exactly. InCharge and Wikipedia also mentioned that consumers often lack familiarity with the whole negotiation process, the typical settlement ranges, the potential pitfalls. That increases the chance of making mistakes, maybe agreeing to a bad deal or not understanding the full terms. Wikipedia notes that if an account does escalate to legal status, like a lawsuit being filed, a consumer negotiating themselves would almost certainly need to seek formal legal help at that point anyway. You also need to be extremely vigilant about reading and fully understanding any settlement agreement the creditor offers, paying super close attention to the fine print. Wikipedia advises potentially getting it reviewed by an independent third party, like an attorney, before you agree.
That sounds like good advice.
And overall, Wikipedia just described the DIY process as one that can be really emotionally draining and requires significant time, persistence, and organization.
Okay. So while that Western Bend 5309 story is proof that DIY negotiation can be highly successful and save you substantial fees, it also clearly demands a certain level of persistence, emotional resilience, maybe some knowledge of the process, and it definitely carries its own distinct set of challenges and risks compared to the alternatives, even assuming you find a legitimate professional to work with.
That seems like a very fair summary based on the information provided across all these sources. It's a path that requires carefully weighing those significant potential cost savings against the required time commitment, the potential emotional toll, and that distinct set of risks involved.
All right. We have taken a really comprehensive look now at what debt settlement is, the whole array of significant risks it presents, and the safer alternatives discussed in these sources, including the very real potential, but also challenges of negotiating debt yourself. Before we wrap this deep dive up, what key consumer protections and practical tips do these sources offer to help you, the listener, navigate this complex landscape, whether you're considering options or just trying to avoid potential scams?
Yeah, several sources, particularly the BBB, that New Era 14 Questions document and Experian, they really stress the importance of knowing your rights and being able to identify those warning signs we talked about. The BBB source specifically outlines several relevant federal laws that provide a baseline of protection.
Like the Fair Credit Reporting Act, the FCRA.
Yes, the FCRA is key. It guarantees you free access to your credit reports annually from each of the three major bureaus, Equifax, Experian, TransUnion. And importantly, it gives you the right to dispute any errors you find on those reports without charge.
Okay, what else?
The telemarketing sales rule, the TSR, is also absolutely critical in this context. It requires debt relief companies to clearly disclose their terms. It prohibits them from making misrepresentations. It makes those annoying, unsolicited calls illegal. And most importantly for this discussion, it strictly prohibits them from charging those advance fees for debt relief services before the services are actually completed.
That upfront fee rule again.
Crucial. Absolutely crucial. New Era and Wikipedia strongly reinforce this. Point fees can only be collected after a settlement is reached, after you approve it, and after you've made at least one payment towards that settled amount. Then there's the Fair Debt Collection Practices Act, the FDCPA, which applies mainly to third-party debt collectors, but also some companies working on debt, providing protections against abusive or deceptive collection tactics. And finally, the Credit Repair Organizations Act, CROA, which specifically prohibits advance fees for credit repair services.
Okay, so these laws offer a vital baseline of protection, especially against the most predatory practices like those illegal upfront fees. What practical tips do the sources give for spotting bad actors or maybe making a more informed choice if you are still considering working with a company after hearing all this?
Well, the absolute number one tip, repeated again and again as the most critical red flag across multiple sources, never pay any significant upfront fee for debt settlement services. The BBB tip, New Era, extremely clear, it's illegal, full stop.
Got it. Never pay up front.
Be very cautious of any company claiming any kind of government affiliation or endorsement. The BBB scam examples highlight this as a common tactic. Critically examine any guarantees they make. The BBB notes that few companies can realistically guarantee that a specific creditor will actually agree to a negotiation or what the outcome will be.
Right. Too many variables.
Don't allow yourself to be rushed into signing anything. Scammers often use high-pressure tactics to prevent you from thinking clearly or doing research. Avoid giving out personal banking information, account numbers, routing numbers, until you are 100% certain the company is legitimate and you have made a firm decision to proceed with them. And simply refuse to work with any company that is unwilling to clearly and patiently explain your rights as a consumer.
That New Era 14 question source provides such a fantastic, actionable checklist, doesn't it? Coming from an industry perspective, these are the questions they say you must ask any company you're considering.
Yes. That list is really invaluable for vetting companies. It prompts you to ask things like, do you charge fees before achieving a settlement? The correct answer you want to hear is no, that's illegal. Are you an attorney-based firm? And understand if that adds extra costs or supposedly changes the legality of business. Remember, New Era says it doesn't exempt them from the fee rule. Are you accredited by the Better Business Bureau? Do your own employees do the negotiation in-house, or is it outsourced to someone else? New Era advises caution with outsourcing.
Okay, keep going. That's good stuff.
How long have you actually been in business, and how much debt have you successfully settled for clients? Can they provide verifiable proof of their claims and success rates, not just vague promises? Can they guarantee they can stop creditor calls? The truthful answer here is no. They cannot legally force creditors to stop calling you, although communication might shift to them, producing calls to you.
Right.
Will I still be making monthly payments to my creditors while in your program? The correct answer for settlement is no, you'll be paying into the settlement company's escrow account instead.
Right.
Can I get sued while I'm in the program? The truthful answer is yes, the risk definitely exists. How will this affect my credit score? The truthful answer is it will negatively affect it, likely, significantly. When can I realistically expect the first settlement to occur? New Era gives a rough estimate of maybe 6 months, sometimes 90 days, but stresses it's highly variable. You give me an exact time frame and total cost for resolving all my debt. The truthful answer is no, there are far too many variables for exact guarantees. Are there tax consequences for the debt that gets forgiven? Truthful answer, yes, potentially. And crucially, who is actually holding my money? It absolutely should be a third-party, FDIC-insured escrow account, not the settlement company itself.
Wow. Asking those specific questions, which come directly from a source within the industry, seems like a really powerful way to gauge a company's legitimacy, transparency, and honesty.
It really does. It cuts through a lot of the marketing fluff.
So those questions are essential if you're considering that path. What steps do the sources suggest you should take on your own before you even think about contacting any kind of debt relief company, settlement, or otherwise?
Yeah, Experian, the BBB, and Investopedia all strongly recommend starting by getting copies of your free credit reports. You're entitled to one from each of the 3 major bureaus every year at annualcreditreport.com.
Okay, start with the reports.
Yes. Review them thoroughly. Understand exactly which debts you have listed, the current balances, who the creditors are, and get a clear picture of your current credit standing. The BBB tip specifically suggests calling your debt holders yourself first, especially if you're already behind on payments, just to see what options they might offer you directly before involving anyone else. As InCharge noted, creditors are often willing to work with consumers.
Good point. Try direct first.
Use resources like the FTC website, ftc.gov, to understand how to access your free credit reports safely and securely. Also, simple habits like regularly checking your monthly bank statements for any unexpected charges are crucial for overall financial health and spotting potential issues early. That's a BBB tip. And fundamentally, just follow basic budgeting and debt management principles to really understand your own income and expenses, your cash flow. Knowledge is power here.
And finally, if someone does encounter a problem or suspects they've been targeted by a scam, where should they report it?
The BBB source provides clear reporting options. You can report problems directly to the Better Business Bureau itself or use their online BBD scam tracker tool. You can file a complaint with the Federal Trade Commission, FTC. Their website is ftc.gov, or the number mentioned was 877-FTC-HELP. The Consumer Financial Protection Bureau, CFPB, is another key agency. Their website is consumerfinance.gov, and the number given was 855-411-CFPB, which is 2372. And you can also contact your own state's Attorney General's office as they handle consumer protection at the state level.
Okay, so to try and pull all of this together for you, the listener, we have taken a really deep dive today into the world of debt settlement. We've explored its undeniable appeal, right? That promise of potentially reducing your debt load. But we've also uncovered the very significant, well-documented risks that come along with it, based entirely on these sources you provided.
We've seen how that core mechanism stopping payments inevitably leads to severe, long-lasting damage to your credit score. We've discussed the potential for accounts to be charged off, how company fees can sometimes eat away a huge chunk of your payments, the unpleasant surprise of a potential tax bill on forgiven debt.
Right.
The unfortunate reality of scams operating in this space, the fact that there's absolutely no guarantee the process will even successfully settle all or even any of your debts, and that ultimate risk, however large or small, of facing lawsuits and potentially wage garnishment if things go really wrong.
And we've also carefully examined the alternatives presented in these sources, things like credit counseling and debt management plans, which focus on paying your debt back in full, but with potentially better terms and much less damage to your credit.
Yeah, and debt consolidation loans or balance transfer cards, which can save you significantly on interest, but generally require you to have good credit before you start.
And that intriguing possibility of negotiating your debts yourself, a path that definitely saves on fees and, as we saw in that one real-world example, can lead to significant success, but also clearly comes with its own unique set of challenges, time commitments, and risks compared to working with a legitimate professional.
So I think the fundamental lesson to take away from this whole collection of sources seems abundantly clear. While getting out from under crushing debt is absolutely crucial for regaining financial control and peace of mind, the way you choose to do it matters immensely. Yeah. Companies that promise those rapid, dramatic debt reductions often require you to take actions, primarily stopping payments, that essentially trade that potential short-term principal reduction for severe long-term damage to your financial foundation, especially your credit score, which impacts so much else.
Whereas the safer paths outlined in these documents, the ones that involve continuing to pay down your debt in a structured way, or negotiating directly with creditors while staying current if possible, though they might be slower, or require different qualifications like good credit, they appear positioned by these sources as being much more likely to protect your overall long-term financial future more effectively.
Yeah, think about this for a moment, just as a final thought based on everything we've read here. These sources reveal that even someone working inside a bank's collections department personally views professional debt settlement as a significant gamble they wouldn't take.
Right.
And a leader from a major national consumer advocacy group, the NFCC, compares considering immediate debt settlement to suggesting amputation as the very first response to just a scratch.
That's a powerful image.
It really is. Yes. So, given the documented risks we've covered, the relatively low completion rates shown in some data for settling all debt, and the clear availability of alternatives, including paths like nonprofit credit counseling that focus on affordability and paying debt in full, or even the documented success people can have with direct negotiation.
What does it say about the broader financial system, maybe financial education, or the support available, that so many people who are struggling and feeling desperate turn to debt settlement first, despite all these substantial documented downsides? It's something to really mull over.
Definitely something to think about. Use all the detailed information we've unpacked here today, drawn directly from these sources you shared, to evaluate your own unique situation, weigh the pros and cons presented, and make the decision that feels right and safest for you and your long-term financial health.